All right. Um, Man, I have eaten so much today, it's not even crazy. I know when I first started recording these videos, I was super hungry. Now I'm super stuffed. Um, all right, so we're getting to the end of the day here, and I want to go out. So I'm going to cut to the chase. These next questions all kind of have to do with the transactional analysis that we were talking about in our second lecture, which was we need to observe specific transactions and then get those into the accounting equation. And so here is our accounting equation. They give it to us already. So we don't even really have to give thought to what each of these accounts are. They're already telling us cash is an asset, accounts receivable is an asset, accounts payable is a liability, common stock is equity, dividends, revenue, and expenses are equities as well. Okay. So it's just going to be similar to what we've been doing. The company completed consulting work for a client and immediately collected cash of 6,400. I think the two accounts that got affected are cash, 6,400, and then revenue, 6,400. Revenue is the term that we use to refer to the cash or money that we earn from selling our products and services. I'm just going to do three of them. Actually, I might just do two of them. So the first transaction, we just enter the amounts and it looks like we're good. B, the company completed commission work for a client and sent a bill for 4,900. Again, the definition of earning revenue or recognizing revenue is that we have to deliver the product or service, and then the customer has the choice to pay or pay later. This instance, the customer is choosing to pay later, which is why we are sending a bill. So I would treat this as accounts receivable, and accounts receivable is an asset. And then I would also treat this as revenue. And after these two transactions, I think our total assets equal our total liabilities plus equity. Looks like I have, what is that, 11,300 in total assets, and I have 11,300 in equity. So I think we're good. I don't see any transactions in this question that aren't somewhat similar to what we've already been talking about. Ah. Um, the company, or C, the owner invested 10,800 of equipment in the company in exchange for common stock. So it's not always the case that we would contribute cash to the business. We could also contribute other things of value, and in this instance, we're contributing equipment. So I think I would just say it's 10,800 in equipment, and then in exchange, we would get 10,800 worth of common stock, or that would be our capital. We purchase supplies on credit. That would be accounts payable. I think I'm just going to keep going. This might be the last. Yeah, that was the last transaction question.